Ladies and gentlemen, good day and welcome to NEOGEN Chemicals earnings conference call. As a reminder, all participants' lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note this conference is being recorded. I now hand the conference over to Mr. Nishit Solanki of CDR India. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and welcome to NEOGEN Chemicals earnings conference call for analysts and investors. The call has been hosted to discuss the second quarter and first half financial performance of the company and share the operating highlights. Joining us today on the call are senior members of the management team, including Dr. Harin Kanani, Managing Director, Mr. Anurag Surana, Director, and Mr. Ketan Vyas, Chief Financial Officer. We will commence the call with opening thoughts from the management team, post which the session will be open for question and answer session. At this point, I would like to add that some of the statements that may be made or discussed on the conference call today may be forward-looking in nature. The actual results may vary from these forward-looking statements. A detailed disclaimer in this regard is available in NEOGEN Chemicals Q2 and H1 FY21 investor presentation, which has been shared earlier. I would now like to invite Dr. Harin Kanani to share his perspectives. Thank you, and over to you, sir.
Thank you, Nishit. Good afternoon, everyone, and a warm welcome to you on NEOGEN Chemicals Q2 and H1 FY21 earnings conference call. I hope all of you are safe and good health amid the ongoing COVID-19 pandemic situation. I will commence today by sharing my views on the financial performance and covering key developments during the quarter under review. I am sure all of you would have gone through the results document shared earlier and also uploaded on the stock exchanges. Before proceeding further, I would like to take this opportunity to introduce to you Mr. Ketan Vyas, who joined us last month as Chief Financial Officer and is on the call with us today. Ketan is a fellow member of Indian Institute of Chartered Accountants of India, an MBA, and has a professional certification in project management from PMI USA. Before joining NEOGEN, he has a cumulative 22 years of diverse finance and accounts, Indian and international taxation experience. Most recently, he was Group CFO at Bartley Boy Limited and has previously worked with leading companies such as ArcelorMittal Projects India, SGS India, Dow Corning India, and Rhodia Chemicals India. He will be interacting with many of you as part of the NEOGEN management team in future. Along with Ketan, we have made several senior level appointments over the last few quarters to expand our management bandwidth in support of our growth objective. Now continuing to the financial result discussion, in Q2 of financial year 2021, we reported a positive top line performance driven by favorable product mix and supported by better demand for new products from customers. This came in spite of impact of COVID-19 and some capacity constraints in specialty organic chemical segment. I am pleased that we have demonstrated sustained organizational resilience and with the dedicated support of the growing NEOGEN family. Our operations have continued to function efficiently in compliant manner within the framework of the altered work environment. Promising demand visibility across key end user industries have given us the confidence to operate our plants at high utilization levels in a sustained manner. Revenue of Q2 FY21 demonstrated a growth of 6.3% to rupees 82 crore. This was supported by 6% growth in organic chemical segment to rupees 67 crore, while 10% growth came in from inorganic chemical segment at rupees 15 crores. For Q2 FY21, our domestic and export mix stood at 44% and 56% respectively, which is higher as compared to some of our previous quarters. EBITDA in Q2 FY21 increased by 5% to rupees 15 crore, translating to EBITDA margin of 18.8%. Focus initiatives on cost management steered the EBITDA performance, which was delivered despite higher costs incurred during the quarter to provide an additional layer of safety for the employees during the pandemic. This is reflected in higher employee costs and other expenses to the tune of rupees 1.41 crores in the first half of FY21. Profit after tax moderated to rupees 7 crores in Q2 FY21, primarily on account of higher depreciation in line with the new capacities added and increased finance costs related to capex done last year. Apart from this, we also had a one-time impact of rupees 55 lakh in Q2 FY21 related to Ind AS adjustments towards processing fees towards earlier financial loans. Our PAT performance would have shown year-on-year improvement but for these factors. As on today, all our manufacturing units are functioning at near to peak utilization level in line with the improved demand scenario, other than some downtime related to COVID and some shutdown taken for modifications for adjusting new molecules. Barring the recently added inorganic plant, which is also scaling up as expected. Our organic expansion at Dahej SEZ, where we are doubling our reactor capacity, is progressing well and is scheduled to be operated by end of Q4 of FY21, despite the disruption in normal activity over the last few months. Also in its Q2 meeting, NEOGEN's board has approved additional capex of rupees 55 crore at our Dahej SEZ plant to be executed in FY22. This new round capex will expand the company's organic chemical production capacity to 3,90,000 liters and has the potential to further expand our revenues by rupees 150 to 175 crore, which will be utilized over FY24 and FY23 and FY24. The board's decision to commit to the next round of capacity expansion is based on few long-term contracts signed with two leading innovator companies, apart from the advanced discussion of long-term engagement with several other companies, which are also slowly progressing towards reaching a stage where we sign a long-term agreement. We expect that the current round of capex, which is likely to come online in Q4, will be majorly captured by these new long-term contracts which are signed and which are expected to sign in near future. Looking into that, the board has decided for further expansion to set up capacity in FY22 so that in FY23 and 24 we don't have a capacity constraint. This expansion, we believe, will further elevate our position as a leading manufacturer of bromine-based specialty chemicals and a reliable partner for contract manufacturing. Let me conclude by saying that we are well placed to take advantage of the structural position enjoyed by India as a leading supplier of chemical products to global innovators. Our world-class, cost-efficient manufacturing backed by focus on innovative process and product development, our resource readiness has allowed us to build strong relationships with a growing number of long-standing customers and will translate into ongoing value enhancement for all our stakeholders. That concludes my opening remarks. I would now request the moderator to open the forum for questions from participants.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star 1 now. We have a first question from the line of Rohit Nagraj from Sunidhi Securities. Please go ahead.
Yeah, thanks for the opportunity. So the first question is on the long-term contracts that you just talked about. What are the salient features of the contract in terms of the timelines, in terms of any visibility on margins, maybe if the input cost prices go up, and whether we will be sufficiently compensated for the same? And are these facilities going to be dedicated for the long-term contracts, or are they fungible? Thank you.
Thank you. So far, as we've discussed in last few quarter conference calls, NEOGEN has been working with several innovator companies in Japan, Europe, and USA. And as we had mentioned in our earlier calls, that these are progressing stage by stage. So from the various companies that we had worked with two of them, we have signed a 5-year and a 6-year contract. In this, in some sense, the pricing will fluctuate on a yearly basis depending on the changes in the input. So the understanding is that more or less our margins will get protected, of course subject to the right utilizations and right operating performance from our side, and the changes in the raw materials will get adjusted on a yearly basis. These agreements also have a kind of a fixed, have a minimum requirement sort of commitment from the customer that they will buy some XYZ minimum quantity over a 5-year period or over a 6-year period. And in some cases, there is a projection given, there is a more concrete requirement given for the next 2 years, and beyond that, there is a projection given by the customers. So, to answer your third point, whether these facilities would be fungible, that yes, I mean, when some of these are large multi-stage molecules, so they would have a dedicated facility when the molecule is running, but the configuration is such that with we can modify it for other products if it's needed.
Okay, and any value to the contract, like 5-year, there will be a revenue potential of some tangible value?
So what I would say is that, each molecule can be in the range of, let's say, 30 to 50 crores or slightly more per year kind of requirement. Because as I said, there is a total volume in one case which is committed, and in another case they have committed kind of for the 2 years, and beyond that they have just given us a projection, so we have to go with that. So this, yeah.
Sorry, this 30 to 50 crore is for both the contracts?
No, individual contracts.
Okay, so around say 60 to 100 crores for both the contracts on a yearly basis.
Correct, which is the, yes, which will be kind of, again, this is the minimum volume and they can take more than that, but this is the minimum that they need to take.
And this will start from FY22 onwards?
Yes. Right now, we already have started the initial. So in the first year, I've always mentioned that we have R&D, then we have a kilo lab, then we have pilot, and then we have the first commercial run. So the first commercial run we have already started in this year, which is like a trial. And then based on that, the multi-year contract, which will start from next year onwards. So we already are doing, and the increase in the export is partly contribution of these two contracts, just the first commercial runs of those.
All right, thank you. And the second question is on the incremental capex that is being announced after the Q2 results, 55 crore at the Dahej. So here we are doing it for the existing molecules, or is it for the newly developed molecules? Because you mentioned that the potential of 150 to 175 crores will be over a period of maybe 23-24. So what gives us the visibility that we will be able to achieve those revenues? Thank you.
So, as you know, the current organic expansion capacity which is coming in Q4 will increase our capacity from 350 crore to 500 crore. So we are having an incremental capacity of, let's say, 150 crore. Now, if I just take these two customers and another where we have completed the R&D phase and now we have either entered the pilot or we are about to start the first commercial run kind of a status. So when I just add this, the expectation is over next 2 years, just these customers itself will together take away the 150 crore additional capacity that we are taking. So there won't be any additional capacity available for other new products or for our own products additional business, because most of these which I mentioned are what we are working with innovators in agro and pharma space. So they are mostly new molecules and new requirements. So that's the reason the board felt that come FY23, there was always a question even asked in earlier conference call that in FY22, if you try to achieve 450 crore, in FY23, what is the plan for that? So there was a visibility, and we had promised somewhere around November, December is when, so either in this meeting or the earlier meeting, we were to decide on our FY23 requirements and hence the capex to be done in FY22. So based on these positive developments with the long-term contracts and the interest or the projections given by other customers, where we have not yet reached the contract signing stage, but the things are moving in a positive direction. We felt that there's a clear visibility for the first 150 crore. So we should start creating additional capacity for FY23 and 24, which should be available to us.
Yeah, thanks. That's helpful. Just if I can squeeze the last one, how have been the bromine prices behaving recently? I suppose they are going up, and what is our expectation? Thank you.
Sorry, could you repeat that question? Bromine price what?
How are the bromine prices behaving in recent times, and what is our immediate outlook in terms of the pricing? Any demand supply disruptions or any other factors which are affecting the pricing? Thank you.
So I think for this, so as a policy, because bromine is a key raw material for us, we kind of get into annual contract for bromine. But this we got into in the month of, let's say, April or May. And at that time, there was a slight, I would say around 10 or 15% increase on bromine as compared to the previous financial year. So that was something which was on predicted lines, because the Chinese bromine capacities keep going down. So, the bromine prices are still increasing, and that was the trend which we have seen last 3 to 4 years. Of course, if it increases too much, at some point of time, the bulk bromine derivatives, start pushing it back and the demand goes down. So there was also the situation where if the overall economy of the world is less, the bulk bromine demand goes down, and again, more bromine becomes available and the prices kind of soften. So we'll see, but we think, we don't expect very positive or negative movement on a year-on-year basis in bromine. It will be in that 10-15% range, depending on the demand-supply scenario in that given year. Specifically within India, last couple of months, bromine prices have been very volatile and has even increased to 30-40%, but that is only for people who are buying in spot. Who companies like NEOGEN, which have an annual contract, for them the impact this year was around 10 to 15%.
Thanks a lot, sir, and best of luck.
Thank you.
Thank you, sir. We have next question from the line of Kaushal Shah from Danke Securities. Please go ahead.
Thank you, sir, for the opportunity. Sir, congratulations on the upbeat getting new customers. So just wanted a little more clarity on this particular point. We had indicated that the runway was kind of clear for us till FY22. Now that we have got these new customers, what is the kind of visibility that we can see over, let's say, a slightly medium-term future, maybe 3 years or so? Also, in addition to this 55 crore capex, do you anticipate that we will need more capex? Because, to the earlier question, you mentioned that we will probably not have enough capacity available in case we have to, we get new customers. So if you can just highlight on that.
Sure. So I think what we have done is we have now decided to add additional 150 crore capacity in FY 150 to 175 crore capacity for FY22. So what this means is that for FY, and if this gets fully installed in FY22, so you know that in FY23 you have a 650 crore capacity available. Of course, like I said, we will then again, so we feel that is a significant capacity available for growth. So, there's enough headroom for growth for FY23 available for us. Then, in FY22, we can go and ask the same question to ourselves around the same time. As I mentioned, the optimal time to decide is somewhere around December. So, we can take the decision either in November or February. So, by November 2021 or February 22, we will decide that depending on the way the business is developing, should we, further invest more capacity in FY23 to take it beyond 650. So that will depend as we, go forward. And again, as you said earlier, we have both the sites and there's a possibility to increase capacity at both the sites. So we can keep reviewing this business every year and take a decision going forward what additional capacity is needed.
And so on the margin front, the upcoming orders that we've got or that we will start servicing, they are coming at roughly the same margin level, or they are coming at a better or a lower level?
So at present, I would say they are at the same margin levels. But what happens is these are new molecules for us. So generally the practice is that as we start working with them commercially over 1 or 2 years or 3 years, we look for improvements, and then when you do that improvement, you share with your customer the benefits of that. So some customer gets benefited, some you get to do. So at present they are the same, but as I've said earlier that especially in these advanced intermediate innovator molecules, there's always room for improvement because they are very, very new. So as we will do this improvement, let's say over FY22, FY23, once we have done this 2-3 years, that's where, there is a potential for us to make a higher margin.
Sure. And so earlier in the earlier quarters, we've kind of guided for this 450, 500 odd crore revenue number for FY22. I believe now, given the fairly clear visibility, we should not have any issues in achieving that number.
Yeah, so these contracts help us, to get a better visibility of the 450 crore number. So I've always said we'll have a 500 crore capacity, but the target was to at least reach 450 crore in FY22. And yes, these contracts will, work towards that guidance, we have a more stronger belief, at least from a business or the demand side of it, to be able to achieve that number.
And so one final question on the funding part. So will we be using internal accruals for this CapEx, or we will be taking on some debt?
So the existing, which is enhancement, which is currently happening, is happening with debt. And even for this additional 55 crores that we have planned, we have always, our belief is to go and have a long-term debt for that, because we feel that when a company which is growing very fast, it's always good to have long-term investments funded by long-term loans, and rather than use a working capital utilization. If our generation is enough, we will have a lower working capital utilization. So we will be going for a debt, long-term debt for this additional expansion.
Sure, that helps. Thank you, sir. I'll get back in the queue.
Thank you. We have next question from the line of Nav Bhardwaj from Anand Rathi. Please go ahead.
Thank you, sir. Congratulations on your numbers and the 2 new contracts, Dr. Harin.
Thank you.
A quick question, sir, would be the long-term contracts that we have are getting right now. You also mentioned that we are post the R&D stage for about 4 to 5 more such kind of commitments. Is that a correct understanding?
That's right. So let's say totally we have worked with around 6-7 innovators, out of which innovator companies, out of which 2 of them have now already resulted into contracts, and with remaining 4 to 5 companies, the R&D stage is over. The R&D samples have been approved by the customer, and at the end of R&D, we feel we are able to meet the cost targets which the customers have given us. So we are either proceeding for a pilot trial, and in some cases even pilot is completed, and post-pilot, the customer is in the process of taking a decision for the first commercial order kind of a situation. So generally, after you do the first commercial trial, where you demonstrate that you can make that molecule at a commercial level with certain efficiencies and can achieve the quality, that's when the customer then thinks of getting into a multi-year significant commitment kind of a commitment.
Great. Well, that throws a lot of light on our earning visibility, but then renders me to a question about our cash conversion cycle and our working capital, because we had earlier mentioned in our calls that because of greater capacity coming in Dahej, probably working capital is going to limber down to smaller numbers, because we'll have higher capacity for our current products. But if the capacity is going to be utilized for other products which are going to be having dedicated molecules, how are we planning to bring down our working capital cycle in the future?
Sure. So now 2 or 3 ways to improve. So one is, as we start doing these molecules, where the single molecule business itself is now more. So, our average per molecule kind of increases, and while they are multi-use reactors, but we can have a dedicated reactors running them, right? And there's a better visibility that we get from our international customers. So as more and more business gets done through these kind of customers and these kind of molecules, that helps you plan better and improve your working capital cycle. Also, this is the first time, for example, where let's say next year we said we have a capacity available for 500, but we are going to try and achieve 450 crores. So we have kind of kept a 10% headroom. Similarly, in FY22 itself, we are setting up a 650 crore. So let's say going into FY23 and 24, we'll have a 650 crore capacity against which whatever is the utilization in that given year. So, we'll always have that extra room available where, we can then have some kind of a comfort on that. The second area which we worked on, and partly you have seen the result, that there are 3 parts, right? I mean, debtors, creditors, and your stock.
Right.
So
Right.
This capacity constraint is with regards to the stock part of it. But when it comes to debtors, again, when we are getting into this contracts also, we are mindful to try to see to have terms where, our debtor cycle can improve as we do more business with them. So that will help us improve the debtors. And what we have done is that, since NEOGEN is into a business which requires longer working capital cycles, we have also started working with our key vendors. And these key vendors, we have requested if they can give us a longer credit term. So some of these vendors have responded positively, and with NEOGEN's strength and now also better visibility in the financial market and better financial strength as compared to 2 or 3 years ago, slowly they are also giving us a longer credit term, and some of them are able to also get it discounted from their bankers and get the money still faster. So they give us longer, so it's kind of a win-win based on NEOGEN's credibility. So that way the creditors are also increasing. So higher creditors, higher debtors, and then the last part is the
inventory stock.
Yeah, for which we are trying to take these decisions early on. So we have that extra capacity, and we are currently not running neck to neck. I mean, just imagine my current scenario where we already are onboarding this customer and accommodating their commercial trial productions. At the same time, we all know that for last 4 quarters or 5 quarters, NEOGEN has been running at already full utilization level. So we are already at full utilization level. On top of that, we are doing modifications sometimes to make these new customer molecules. And at the same time, we also have some challenges related to COVID. And still we are satisfying our regular customers. So these are the challenges which we currently are going. And one of the advantage of taking this decision in a little bit in advance is that we have sufficient time to get this capacity in our next financial year, and then we always have some extra capacity available that if an opportunity were to come, we can quickly grab it. So that's the whole idea. I had promised in my earlier call that somewhere around December we will take a call, but luckily this customer commitments came in, so we were able to convince the board and start it a bit earlier. So we'll always keep some headroom available for either additional growth or at least to make sure that we have comfortable operation and we are not always running at full utilization levels.
That's wonderful to hear, sir. Also, the entire R&D has been done by our team and in-house for all these products, right, sir?
Yeah, so R&D of course has been done, but like I said, in some of the contract manufacturing projects, the customer team has done the initial R&D at few gram levels, then it has been transferred to us, and then we've done the kg level and the scale up, and now the commercial plants. And
last question on this, sir, would be like which areas of are we targeting in terms of, are they agrochemical products or are they pharmaceutical products or anything else? If you could comment on that, please.
So if I take this total 6-7 innovators which we are working, so we have agro, we have pharma, and the third category I will just say non-agro, non-pharma. So it's a different, I'll not name the industry, but I would say it's non-agro, non-pharma. So it spreads across 3 different industries. Even the first 2 which we, although I would say as a percentage, the agro is on a higher side. So even the export increase that you see in this particular quarter has been for one of the agro molecules, and we've also seen the agro as an industry cross 10% and move into 15% in a quarter for the first time.
All right, that's it. Thank you from my side, and all the best going ahead, sir.
Thank you.
Thank you. We have next question from the line of Bharat Shah from ASK Investment Managers. Please go ahead.
Yeah, hi, Harin. Just to capture all that you said in terms of the expanded capacity or plan to be expanded and incremental turnover potential. So what we are seeing is in the current year, by the time our expansion is through, for FY22, we would have a potentially 450 to 500 crore capacity. By the time FY22 is through with the additional capex plan for the next year, the 55 crore, we would have turnover potential of 650 crore in the following year. And then what needs to be committed to FY23, the call will be taken sometime towards the end of the next calendar year. Am I right in understanding?
Yes, you are right in understanding.
Right.
Thank you, sir. We have next question from the line of Dhruv Bhatia from BOI AXA Mutual Fund. Please go ahead.
Hi, sir. Thank you for the opportunity. Just a couple of questions in on the contracts, the 2 contracts that you have won. Are these contracts for advanced intermediates? Are these contracts for CSM? Could you just quickly clarify that?
Yeah, so one of them, so CSM mostly is advanced intermediates. Advanced intermediates, basically we break it down as our own advanced intermediates or CSM. So in this particular case, this one of the contracts that we already signed is advanced intermediates under CSM, and the another one which we have is our own bromine molecule and another bromine derivative which we exclusively develop for that customer. And majority of the others, 4 with the innovators, 4 or 5 additional which are in the pipeline, they are all under the CSM and under advanced intermediate mode.
Okay. And when you say that these are for innovator companies, are these products which you are going to service? Are they generic products, patented products? Can you first just tell us that?
To the best of my knowledge, most of these are for the innovative molecules, so which are just launched. So they are still not yet generic. These are still under patent molecules.
And are you replacing the, is the customer itself doing these molecules which is getting outsourced to, Neogen, or is it that you are replacing an outsourced vendor?
So in some cases, we are the first vendor, and in some cases, the customer had originally planned with somebody in China, but the Chinese company fell through because of what happened in last year. So they approached Neogen, and Neogen is the second vendor for them, is the main vendor for them now. And in some cases, the customer has maybe one vendor in China or somewhere else, but they were looking at a second vendor. So we are the second vendor in that case.
Sure. And you mentioned that for the first year, you are looking at 35 to 50 crores revenue per contract, and then it ramps up to between 75 to 90 crores from FY23 onwards. Is that correct?
No, what we said is in each of these contracts that so far we have signed, there is a potential of 30 to 50 crores on a yearly basis. That range depends upon the exact volume and the exact price which we work out on a year-to-year basis based on the demand projection from the customer. And they have a potential, so this is the minimum volume, and then the customer has an option to even take more. So that again will depend on a yearly basis.
So are you putting up this 150 to 175 crores revenue potential capacity based on the ramp up that is expected from the customers, or are you putting up this incremental capacity for new customers also, which you think are going to get converted into customers for you?
So, as we said earlier, internally we always want to be very conservative when we are taking any capex decision. So, as I had shared earlier also in my conference call, that we had one option that the entire 150 crore, we have a commitment from just these new customers, and there is another option where let's say none of these new were to work out. We would just use our own molecule for our existing customers and do more of that. So we had this two spectrum, and then we said, the actual will be somewhere in between. So this is what I have been sharing over last 2-3 conference calls. So now basically what is happening that some of these new have become clear, and we still have unmet demand of our existing molecules. So with that and looking at now more clearer projection from the innovator customers or the new customer and the new product that we are working with. So based on that, we can now go ahead and take a call that, okay, there is a very good certainty now that the 150 crore which we've added will get filled with these as well as my existing molecule additional demand. So let's go ahead and create additional 150 crore capacity because to satisfy all these, we will require more capacity than 150 over 2 to 3 year period time.
Sure. And just last question from my side, when you said that you're working with 6 to 7 innovator companies, and the 2 contracts which are converted out from these innovator companies, how long have you been working on the product development with the customer, and is it that you are working on one product and that the hit ratio has been 100%, or are you working with multiple products with one company and it's just that one hasn't got converted and many on the pipeline?
So usually when we start work with any customer, it depends on the customer needs, but sometimes there can be a single molecule and sometimes there can be 2 or 3 molecules also. So we've seen 3 molecule 4. So again the dynamics of which one comes first, which is higher priority. So in one case which I told you, we are supplying 2 bromine derivatives. One is our own and one we custom develop for the customer. So similarly, so anyway, so the number of molecules per customer are different. But usually it is once we start with one, they also give others. But the first one which you started with is leading, and there could be others also behind them. Or sometimes it depends on customer priority, that this one is launching first, so you focus on this first, then you move on to the other. So that's to answer your question on number of molecules. How long we have been working? Few of these customers we have worked with for 2.5 years. Some of these customers we have worked with, let's say about a year at least, year and a half at least.
And if I may just squeeze in the last.
Sir, I'm sorry to interrupt. Please come back in the question queue.
Thank you.
Thank you. Ladies and gentlemen, in the interest of time and fairness to all participants, please restrict questions to 2 per participant. If you still have more questions, please join the queue afresh. We have next question from the line of Manish Gupta from Solidarity Advisors. Please go ahead.
Dr. Harin, what is the useful life of a plant that you set up?
Okay. So let's say generally the building that we set up have a life of 25 years, 30 years or longer, with modification and strengthening and things like that. So for example, even if you take my Mahape plant, we started using it in 91 and we are still using it. But yeah, inside the reactors keep changing from time to time. Generally the reactors range from 8 or 10 years to even 15 years, 17 years, unless something wrong happens to them specifically. So I would say that's individual component wise, the life of a plant.
Do you take any maintenance capex through your balance sheet, or is all the maintenance capex expensed through the P&L?
The maintenance capex, again, we follow the normal accounting rule that some significant maintenance which is supposed to increase the life of the machinery significantly is considered as capex, but the remaining major is taken as P&L.
So when we are talking about the 55 crore capex,
yes,
that's for the new plant.
Yes.
But will there be some other capex other than the 55 which goes for maintenance capex?
Yes, there will be. We estimate around 10 odd crore of maintenance capex across our other sites. There are 2 parts of this. One is for debottlenecking. Second is to increasing the life, which is the pure maintenance purpose. And third is that, these are like, for example, my Mahape and Karakadi are the one where we have our R&D. So when we want to do a new molecule, sometimes they require some change in configuration or different reactors. So, basically those kind of modifications. So debottlenecking, sometimes new technology. So for example, if you have a vacuum pump, we find a better vacuum pump which is more energy efficient or better operational performance. So then we may also do because of that. So all that goes into the maintenance capex bracket.
Okay. My second question is that over time, I guess since the share of value add in your overall business mix is improving, and you will get some operating level scale, and you will have longer runs as the size of molecule increases. Can we expect some EBITDA margin expansion gradually over time?
So yes, I think internally Neogen as a team is, our peers have EBITDA margins which are much higher. Of course, many of them also have a much higher scale of operation. So we also strive to achieve that as our scale of operations improve, as our, the molecule mix improves, and one of the choice behind trying to work more on advance or with innovators kind of is to see if we can improve our margins and EBITDA and other operating parameters. So that is something which is definitely something that we ourselves are striving to achieve. But again, we are in a rapidly growing phase. So we are rapidly growing. So for that, many a times you take some decisions now which for today are not very good, but for tomorrow and day after, it optimizes your 2 years down the line growth or something like that. So that's the reason where, for example, for the Dahej side, we already have some employees already appointed and some more which will appoint the next quarter. but the capacity may come online, let's say in Q4. So you have sometimes these mismatches, but overall, yes, I mean, once this stabilizes, and also, we are adding new molecules. So once we run with these molecules for a while, we can do some innovations and improve. So together, that should help us improve the EBITDA. But I am not able to put a finger or a time that yes, from this year onwards or from this point in time, we can give you kind of a prediction. So I think earlier also, what I have said that up to FY22, our target is that that's when we are going another significant jump from 300 to 450, and we are operationalizing for organic Dahej site. So that's the major issue. After that, it will be incremental increases at the same site. So we said till FY22, at least from a guidance point of view, similar range of 18.5 plus or minus 1, and during COVID we requested 1.5% range. So that's the range, and then beyond FY22, we will let you know once we are already running at that level and you kind of hit that run rate, and then we have a better idea of the cost structure at that run rate.
Thank you. Very, very useful. Thank you.
Thank you, sir. We have next question from the line of Sabyasachi Mukherjee from Centrum PMS. Please go ahead.
Yeah, hi. Thanks for the opportunity. Good to hear about the new capex announcement. Few questions from my side. First of all, what is your net debt to EBITDA or net debt to equity number that you have thought of?
The current net debt to EBITDA number, just one second, I'm just going to take Ketan's as for the September. Yeah. September 20. Yeah. So we are at debt equity of around 0.82.
And what would be the peak? I mean, after having this 55 crores of it will be funding through long-term debt. What is the peak number? That you don't want to cross beyond which number?
So I think we've kind of kept ourselves, even post IPO in my first or second call itself, what I had given, that our target is to keep it below 1 most of the time. And certain quarters where the capacity is fully utilized and then the equity, the profits will come next year, we can go up to 1.25. So, on an average or a long period of time, 1, and not to try and cross 1.25. So even current projections show we will be comfortably within that range, even in the peak period in basically FY21 and FY22. And then beyond that, we should again reduce below 1.
Sure. I also see a CWIP, capital work in progress, in the balance sheet of 24 crores as on September.
Yes.
Is this something you are doing as part of this 55 crores of capex you have already started, or
This is part of the 75 crore capex which we are currently doing for Dahej. This is where our turnover goes from 350 to 500. So what is going to come online in March, this CWIP is towards that.
Okay. So basically, if I were to look at the gross block number of FY20 March end and the gross block number that will come in March 21, so there will be basically roughly of 80 crores of addition, 75 to 80 crores of addition that has in March 21 number. Is that a correct understanding?
Yes, and there will be some capex which we are doing also in Mahape and Baroda. So around, I would say more closer to 80-85 crore. But I have to just see if some of that 75 we had done in the. But yes, let's go with a number of around 85 odd crores. FY20 to FY21, and then the 55 crore plus another maintenance capex of 10. So another 65 crores in FY22. Based on whatever we have planned up till now.
Got it. One more clarification. I was seeing the cash flow from operations number, in your results document and the presentation.
Okay.
If I look at the cash flow from operations of last year, half year ended September 2019, it was a negative number, right? Around I think 17 and a half crores of negative cash flow from operations in the result document. But if I look at the presentation, it's a positive number. Can you help out me over here? Am I missing?
Let me see if we made a mistake. Just one second. In the presentation. Can I just quickly check and come back to you?
Sure.
Before we finish the call? Yeah. The result no, please.
It's on slide 12.
Yeah, I saw the slide 12, but just let me check the result document. So I see it's 17.7. If it is in the results it's negative, then it's a mistake in our slide. I really apologize for that.
No worries. Yeah, thanks. That's all from my side.
Thank you.
Thank you, sir. We have next question from the line of Ayaz Motiwala from Nivalis Partners. Please go ahead.
Hi, gentlemen. Good evening.
Good evening, sir.
So my question was related to bromine chemistry and the way you've explained in our interactions in the past. From this agro and pharmaceutical opportunity with international customers, it doesn't sound that it is so niche as such. It may be versus benzene, but it doesn't sound so small as an opportunity. So what you would like to learn is, as you approach more customers with R&D work with yours and you move from the pilot quantities to kilo and bigger commercial scale. So what is the kind of opportunity that you are seeing in your strength of organic, inorganic chemistry on what you have on the ground, people and resources?
Sir, so my belief is, yes, that bromine chemistry can be utilized across industries and for several molecules. And historically also what we have seen is that, the bromine derivatives get used in multiple products, multiple end users, multiple customers. The difference is that when you take a $3.5 or $4 bromine, then do you just make a single bromine derivative which is, let's say, $10 or $15, or maybe with one more step around $20, or you then also build on that and do other chemistries, and you are able to reach up to let's say like $100 or $50 or $200 in that range. Now it's the same bromine, right? But what you do with that bromine differs on what is the additional chemistries that you are ready to do. So that's what currently what we are doing, that we are trying to basically go and move forward. And I think one of the things which is important is that are you able to first adopt to these other chemistries along with bromine? And what happens is when we do that over a long period of time, sometimes, so for example, one of the chemistries which come after bromination is Grignard reagents. So these Grignard reagents we have been doing now almost for 20 years, and over a period of time we get expertise in that. So that's how we are looking at this, that we can keep adding to our expertise. We can try taking higher value numbers and take bigger challenges. And that too, now who do you do it for? I mean, do you do it for a generic company, for a molecule where your competition is China, or you do it with an innovator company where you are one of the first or the second company in the world to do that? So then there's a value attached to be able to be the first and the second to do that. So I think that's where we are looking at the potential. And I think here the question is, when we work with bromine, we are also used to handling hazardous chemicals. So your approach and attitude to manage hazardous chemicals, handle tough chemistry like bromine, and also we saw pharma industry, so doing it with a high amount of quality assurance and quality control systems in place. So I think that's the combination which becomes our key strength and makes us a winner or a challenger in this area. I hope I answered.
That's very helpful.
It was a bit broad, so I don't know if I answered.
No, that's helpful, and we can build on this just in the context of a quick sort of question before time runs out. The second one, sir, is related to the expansion plan, which has the revenue growth potential of 150-200 crores and the new 55 crore plan that you're announcing. What should we be thinking in terms of working capital? And so you announced long-term debt would be taken. If you can call out on these two new long-term signed-up projects in the context of, as you said, there'll be an offtake tonnage on one side, there'll be a level of margin assurance, and some amount of sort of working capital and other parts which you may have to manage at the back end. So could you talk a bit about that in terms of the composite capital employed? Will working capital be a large portion? And will you look at your same payback norms of 3.5, 4 years, 5 years? How should we look at that lumpy big investment that you plan to do?
So, over a period of time, we per se feel we should not be looking at one molecule or one business at a time. Overall, as a company, what we've acknowledged is that we need to improve our working capital cycles, because when we want to grow faster, by having better working capital cycle, the need for dependence on debt kind of reduces, and also, you are better protected in case if some things were to go wrong. So that's what we've been doing, and we have to do that at each business. We have to do slightly better as compared to earlier. So that's what we have discussed earlier. One of the constraints for us was not having capacity. Having capacity, improves that, you can make kind of more closer to just in time. But if you are capacity constrained, you can't make just in time. So that is one aspect which we are changing. And the second aspect is that we are also looking at the second aspect is that single molecule contributing more. So on an average. So again, there is a trade-off. If you have, let's say, one single only 10 molecules giving you 10% each turnover, one of them goes down and you have a challenge. So having more molecules is allowing us to grow very fast, because we are in touch with more customers and we have more opportunity. At the same time, it is also making us inefficient. So you have to strike the balance, and we are trying to see that by doing this contracts, we take the balance more towards, a slightly higher per average turnover of a molecule, if I were to say that, which will help us improve have dedicated reactors and reduce the changeover and be efficient. So these are the things which we are working on. And what we have said overall as a business, our effort will be to improve the working capital cycle going FY22, FY23, and there are three aspects which I detailed in my earlier answer to one of the questions asked.
Yes. I think the revenue per molecule part is very helpful. Thank you for that, and the efficiency versus contrasting with margins. Thank you very much. All the very best.
Thank you. And also to just answer earlier question about the negative, there's a small typo error in our earnings presentation. So last year was negative and now it's positive 44. So we will get that changed and have a revised one uploaded on our website. So thank you for pointing it out.
Thank you, sir. We have next question from the line of Shanti Patel from Shanti Patel Investment Advisors. Please go ahead.
Yeah, sir, I have got one simple question. Today, what is our return on capital employed and return on equity? And what will be the situation after our turnover will reach at 500 crores?
So, historically, our return on equities used to range around 18-19%, and return on capital, if you are taking post-tax, used to be around 16-17%. At present, the return on equity is about 16%, and return on capital employed post-tax is around 13.3, pre-tax is around 17%. This is also because we are right now doing the new investment, and also before earlier we have also invested into a lot of land which is for next 20-25 years. So as long as our margins remain the same and we improve working capital, if we go by historical, we were somewhere around 18-19% ROE, and let's say 16% or 17% post-tax, 20% pre-tax ROC. So we will at least try to reach there. And then, as I answered earlier, if our margins improve, if we are able to increase this efficiency and working capital cycle, then they can go beyond the 20% range.
Thank you very much. Thank you.
Thank you. Here's the last question from the line of Bharat Shah from ASK Investment Managers. Please go ahead.
Haran, when we think of our current size of the business, it is still rather small size of the business. And in light of the kind of capital expenditure and expansion we are talking about, plus leveraging that capex, I hope we are not trying to bite off more than we can chew or can afford.
Bharat, we have at least internally been very conservative about it, and we've kind of looked at different scenarios and kept different options in mind when we've taken this decision. As you pointed out, yes, as compared to some of my peers, our size is small, but at the same time, so we want to definitely grow our business because there's a lot of demand coming in from our customers. But of course, we never want to do it at a risk, as you said, trying to bite more than what you can chew. So that's a question we keep asking ourselves always, and at least we believe we are not doing that. Of course, time is the only final prover, of whether we are right or wrong. But we've kind of thought of that, and this is really mainly to make sure that we are not in a situation where we have to say no to our customers, and there's a good opportunity for NEOGEN, as is for many specialty chemicals in India. And when we see a good visibility, only after that we have taken this decision.
Incremental capex, typically what is the cutoff minimum return on capital employed that we believe would be there?
But sorry, I don't have that number on an incremental. What we have looked at is our incremental investment giving us, let's say, additional revenue. So, for example, the Dahej incremental investment of 75 crores we did was giving us a revenue of about visibility of around 150 crores, because this was a greenfield site and we were doing it for the first time in Dahej. Whereas this incremental 55 crore is already giving us a visibility of 150 to 175 crore. So unfortunately, we don't look from that ROI point of view, and I don't have the exact number. But whatever it is much higher as compared to what we did for the first 75 crores.
Thank you. But it will be useful if, in terms of a benchmark is kept, because otherwise capex spend is a certainty. Outcome in terms of profit and top line are matters of conjecture.
Sure. We will have those kind of numbers ready next time on our investments.
Okay.
Thank you, sir. Ladies and gentlemen, that was the last question. I now like to hand the conference over to the management for closing comments. Over to you, sir.
Sorry. Thank you. So I thank everyone for taking the time out and joining NEOGEN for our today's conference call. I would also like to thank CDR team for arranging the same. If you have any further questions, please feel free to contact our investor relation team, CDR in India. I hope I satisfactorily answered all your questions. With that, I would like to end and wish you and your family a very happy Diwali.
Thank you very much, sir. Thank you, ladies and gentlemen. On behalf of NEOGEN Chemicals Limited, that concludes this conference call. Thank you for joining with us, and you may now disconnect your line.